Hey guys, James here with Waterford Business Solutions, and today we're going to talk about your chart of accounts and giving you some examples on some different things to do. Chart of accounts is the backbone of your bookkeeping. Any software, any system that you use is always going to have either a general ledger or a chart of accounts. They can go by either name there. The chart of accounts is the accounts or the ledgers, the ledger accounts that you use to classify your transactions, your liabilities, your income, your expenses, anything and everything there. That's how it's classified, so that when we run a profit and loss or a balance sheet, that is where the money shows up in those accounts. A chart of accounts being the backbone of your system is very, very vital for the setup of a successful QuickBooks system or any accounting system out there. So we're going to spend some time today digging into the different type of accounts, what we should have, and everything under the sun related to chart of accounts for a quick overview. With that being said, a chart of accounts is not a bad idea to reach out to a professional, someone who is familiar with your type of business or your business in general, to help you set up what works for you. But a chart of accounts is also a living, breathing document. It's constantly changing and it's constantly evolving. So with it's constantly changing and evolving, you need to make sure that at least once a year you're going through and reviewing, saying, I don't use this anymore, I do use this, so on and so forth. So from there, let's go ahead and dive in. What I'm showing you guys here is the general chart of accounts that we use to start a customization for a client. Whenever we have a new client join us, we always send this questionnaire here to figure out what type of things they do. Do they run equipment? Do they have inventory? Do they have vehicles? Do they do depreciation? Any investments that the company has or investments from the owner or others in the company? Any liabilities, any loans, cost of goods sold, what those cost of goods sold is, stuff like that, so that we can then come back to this sheet here and customize it for our clients. So I'm going to just start at the top here and slowly go through this list. And there are more accounts than some people need. There's missing accounts that some people need. So this is not a perfect chart of accounts. You still need to customize this to you. This is just what we start out with. So we always start out with our bank accounts. Bank accounts are going to be like your checking account, your savings account, your money market account, maybe the cash that you keep in the office safe, stuff like that. Any type of cash on hand or liquid cash. This is not an investment. This is not a credit card. This is money that you have. So if you deposit into that account, you have that money. If you spend out of that account, you've lost that money. It's not a credit card where you are spending money and you'll pay it back later type thing. It is an instantaneous thing. So we use the chart of accounts and we always start with the bank account. I always have a cash on hand account, because even if you don't have an office, a lot of people will keep $100 or so on them in the truck in case of emergency, something like that. Whereas offices may keep $1,000 or $2,000. So having a cash on hand is not a bad idea. Then we have our checking account and savings account, and we may have multiple of those accounts. It depends on the company. This company or this sample that we have set up has 2 of each. I've got companies that they've got 6 checking accounts and 3 savings accounts, or 7 savings accounts and 3 checking accounts. But you want to have a different bank account, a different account here for each one. And don't just name it checking and savings. Do checking in the last 4 numbers so that you know what the account is. Then we come down here to our barter account. This is not something that everyone has, but there are companies out there that they still do bartering. So for my services, I'm going to, instead of making you pay me $100, I just want you to do your services instead worth $100. So this is not common for a lot of people, but I do keep this in our general account and remove it a lot of times just in case we have clients that do bartering. So that's the bank account area. Basically, you're checking your savings, maybe a CD, money market account, something like that that you're constantly pulling money in and pulling money out of. Then we come down to your AR. This is always a standard account that you have to have. QuickBooks is always going to give it to you. Any accounting system, decent accounting system, will give it to you. Then we have undeposited funds. Undeposited funds is when you receive payment, those are not immediately going into your bank account. You may hold on to that check for a few days. So that's what undeposited funds are. This is a requirement in QuickBooks, and many other accounting systems require this. So we always leave this in. Prepaid expenses. If you're on accrual accounting just for record tracking, not even for taxes, but for record tracking, you may prepay your expenses. So pay 6 months of car insurance up front instead of waiting to pay it month by month. Well, when you pay that 6 months up front, you're paying 5 additional months in advance. So we may have prepaid expenses. Depending on your company and the expenses you have, we might break this down more specifically into prepaid insurance, prepaid mortgage, prepaid rent, prepaid lines of credits for the vendors and stuff. So we may have multiple different things in the prepaid, but a lot of people don't track it like that. So we generally will either pull this out altogether, or we'll just leave a regular prepaid expense just for the seldom time that they use a prepaid expense. Then we have inventory asset. Inventory asset is going to be if you're tracking inventory. If you're not tracking inventory, this is not an account you need. Uncategorized asset is something that you shouldn't use, but this is an account that QuickBooks requires you to have. You should never have anything uncategorized. You should always be able to say this is X. And if you can't say that it's X, add something to your chart of accounts to track it. Because uncategorized leaves you with potential for missing tax deductions, tax write-offs, or being overcharged for taxes in general, or creating a misvaluation of your company. So nothing should ever be uncategorized. Now those are all other current assets or current assets. That means that you currently, or you will be using those assets probably within the next 6 to 12 months. It's something that you will be using very, very soon rather than having it for a long term. As we come down here, you'll see our fixed assets. This is going to be long-term assets, things you'll have for more than a year. So your vehicles and the original costs and accumulated depreciation on those vehicles. Your office equipment, broken down by the equipment you have. If you're a smaller company, a one-man show, two-man show, you may not have very much equipment, so you don't need to break this down. But if you've got multiple people in the office, or you're a larger, maybe multi-million-dollar a year company, we're going to want to see your computers versus furniture versus software, stuff like that, along with the accumulated depreciation on that. Then we have intangible assets. Intangible assets are going to be things like a trademark, a copyright, I can't think of the name right now. But basically, if you own a company and you register your company's name and you trademark it, or you have a logo created and you trademark that logo, depending on your company, that logo, that company name can increase in value and become an asset to the company. For smaller companies, this generally isn't the case, but a big example that we'll use all the time is Amazon. One of Amazon's most valuable things is their name, because you hear Amazon and you immediately think of 2-day prime shipping, of the Echo, of the Fire TV stick, of the Kindle. You immediately think of that. So Amazon considers that to be an asset to them. So if we have a long-running company, a company that's well established in an area or well established in an industry, we might consider your name or your logo an asset to the company because someone might just want to buy that name just to be able to not even have the business that you had, but have the name recognition that you have. And then we have machinery and equipment. That's going to be tools that you have, expensive tools. If you have a drilling rig, or if you have generators or carpet cleaning machines, or sump pump or septic tank pumps, or expensive HVAC tools or equipment or cranes, something like that, that would all go in machinery and equipment. And it looks very similar to our vehicles because it's basically the same thing. The only difference is a vehicle is going to be something that you drive, whereas machinery and equipment is going to be something in the back of a vehicle or on a trailer, because that's equipment. So if it doesn't have an engine in it, it's going to be a machinery and equipment compared to vehicles. Now that engine, obviously, if you've got generators or something like that that you can't physically drive, then that's also going to be machinery and equipment. Then we have accounts payable. This is a standard thing, especially if you are entering bills, paying your bills, etc., over time. So this is a standard thing that we will normally see here. Is this AP? This is required in QuickBooks, and almost all accounting systems require this. Then we have our credit cards. So credit cards are separate from the bank accounts because credit cards are a liability. As you spend money on it, you owe that money back to someone. So we will have all of your credit cards here. If you've got multiple cards, we'd have multiple cards here. I only have 2 cards set up here because that's kind of the standard for a smaller company is 1 or 2 cards. But there are larger companies that they have a card for each and every employee, and we can have 10 or 20 cards here. For every credit card you have, if it is treated as its own account, then you need to treat it as its own account here with its own credit card. Gift cards, this is not something that is common, but there are some companies out there in the home service industry that they will allow people to buy gift cards to give away. When you sell that gift card, I'm on the wrong line there, when you sell that gift card, ultimately you have a liability out there. You owe someone money type thing until that gift card is used. So if you do gift cards, make sure that you have a liability account for your gift cards. Basically, it's a deferred income account. Same thing that you see here. If you take payment up front for like a down payment or something, that might go into deferred income until you have finished the job. So if you're doing a big HVAC job or even a big general contracting job that you're building a $500,000 house and you require a 10% deposit, $50,000 deposit, or a 20% or whatever, and you take $100,000 up front, you haven't earned that income until you actually do the work for it. So we will have a lot of times deferred income. Unassigned tax agencies payable, this is again another requirement. Generally it's going to be a sales tax payable account. And you can change this name to sales tax payable. We leave it unassigned tax agency because we deal with so many tax agencies. So you'll want to have Florida tax agency or California or New York or Wisconsin or whatever you have there would be your tax agency payable. Income tax payable, so if you have an accountant or someone helping you figure out your potential for income tax, or you owe money to the IRS from previous years, we would use this income tax payable. If you owe for previous years, we'd want to break down each year there. But if you know, or if your accountant tells you, hey, plan on paying $10,000 in income tax, we can put that in this account so that we have it recorded on our balance sheet. Insurance payable, that would be basically the exact opposite of what we talked about up here in our assets of prepaid insurance or a prepaid expense. If you accumulate insurance, so workers' comp, or even car insurance. Sometimes you can accumulate car insurance. You would put it up here in insurance payable. This is getting into more accrual basis accounting stuff that a lot of companies don't do. So you may not have a lot of other current liabilities up here. An other current liability is going to be exactly the same as an other current asset. It's going to be a liability that's going to come due within the next 6 to 12 months. One thing that you'll see here is current portion of long-term debt. Whenever you have a long-term debt, any loans, anything like that, you will have a portion of that that is due within the next 6 to 12 months. So we always want to reclassify that into this current portion of long-term debt so that we see what you owe in the next 12 months and what you owe long-term separated out. Long-term liabilities are going to be long-term liabilities, things that you will be owing over a longer period of time, maybe 2, 3, 4, 6, 30 years, rather than due in the next 6 to 12 months like other current liabilities. So any car loan, any SBA loan, any bank loan, any line of credit would all go into long-term liabilities. Then we come down into equity. Equity tells us like the amount of retained, basically what is left in the company after we take all of our assets, all our bank accounts, all of our assets, and pull out all of our liabilities. So equity tells us that. We always have owner's investment, and then owner's pay and personal expense is two separate accounts, because a lot of business owners will invest money into their company and pull money out of their company throughout the year. And at the end of the year, we need to report that to the IRS because that could be taxed, potentially. So we always keep track of that. That way, if you invest money and pull money out at the same time, we can have that go against each other. Opening balance equity is a required account in any QuickBooks. And this is if you're starting fresh with QuickBooks, but you're not a fresh company, this is where you would put your opening balance, the beginning balances for your accounts. Retained earnings is going to be earnings that you received in previous years or previous months, depending on when you're looking at your balance sheet, that are carrying over, but they're not showing in your net income. So if you set a net income for this month, you would have retained earnings from all the way previous to that. So we're currently in November. So if we set net income to show us for November, we would see retained earnings from January until present throughout the company. Estimated taxes is another equity account. Some people, instead of having income tax payable because we don't know that it will be payable, will put in an estimated taxes as an equity account. Again, this depends on the company and what we're doing here. So that's going through basically all of your balance sheet accounts. This is highly, highly customizable due to the fact that everyone has different bank accounts, different number of bank accounts, different vehicles, equipment, computers, loans, credit cards. So almost all of these accounts will need to be customized specifically to you and your company. As we move on down here to the income and expenses, this is going to become a little less customizable. Income is going to be any type of money that you receive into the company as primary income. So if you are a plumber, any type of work that you do that is primary income, primary things, so septic tanks, installs of whole house plumbing, unclogging drains, snaking a whole house vent, installing a sink, stuff like that, that would all be considered primary income. You can be very simple here and just have like a sales account, which is kind of what you see here because it's very simplistic because we don't have it customized to a specific business. But I recommend figuring out what your key things are. So if you're a plumber and you do a lot of septic tanks, a lot of whole house installs, a lot of service calls, and a lot of small little remodels and stuff, we may want to have 4 income accounts or sales accounts so that we can see month over month how you're performing in your whole house installs versus your residential maintenance or your residential drain unclogging versus your septic tank, and we see over a period of time how your company is performing and changing. So this will be highly customizable here because it depends on your company. If you give discounts or refunds, you always want to have a discounts or refunds given account, because we want to count that against any income you make. Anytime you discount a job, make sure you are counting that so that you're taking full advantage of the taxes. Then we come down here and you'll see another uncategorized income and unapplied cash payment. Both of these are required accounts that we have to have in here. Billable expense can be the same thing depending on the setup in your QuickBooks. Uncategorized is always required. Unapplied and billable can be removed depending on settings that you set up here. Make sure that you remove what you don't need, or make sure settings are turned off that you don't need. Next down, we'll see cost of goods sold. I only have one cost of goods account here because, again, each business is different. Cost of goods is any type of cost that we can directly relate to the sale of whatever you did. So if you're a plumber and we can directly relate 2 hours of your paycheck to a job, then we would have cost of goods sold there. If we can directly say, hey, the purchase of this stuff was for this job, we could count that as cost of goods sold. This is widely misused because a lot of people, anytime they buy job supplies, even if they're restocking a truck, put it in cost of goods sold, but they're not putting it against a specific job. This is only for against a specific job. And cost of goods sold would work very much like your income accounts, where you would have different cost of goods sold accounts depending on what you're doing. So going back to our plumber example, we may have cost of labor, we may have cost of piping, we may have cost of fixtures, we may have cost of licensing or cost of permits for a plumber, whereas for an HVAC technician, we may have, again, cost of labor, but cost of units or cost of duct work or cost of electrical wire, stuff like that, because you're going to have different things than our plumbers will have. So figure out what your major costs are, not every single cost you have, not every single little thing, because we don't want to break this down too specifically. If you only have one expense or 2 expenses or 3 expenses a month to a specific account, you should be able to merge that with something else unless it just doesn't fit with something. And there are times where stuff doesn't fit with anything else. Then we come on down here into our expenses. Expenses are going to be fairly standard, and I'm not going to really dig into anything specific here because we're going to provide this to you guys to look at yourself. But what you will see here is we have expenses here, and then we have other expenses. Anything that is an expense is going to be a direct business expense, direct basically cost of doing business. Not a cost to do a job, but cost to do business. So your payroll, that's a cost of doing business. Your utilities, cost of doing business. Rent, cost of doing business. Your travel, if you travel a lot for business, could be a cost of doing business. Meals and entertainment could be a cost of doing business. Insurances, taxes, dues, all of that stuff could be a cost of doing business. But then we have other expenses. These are non-specific expenses or maybe non-exact costs of doing business. So car and truck, we may not want to consider a direct cost of doing business. We may want to total kind of what it costs for us to do the job separate from the car and truck. Some people are the same thing if they have a home office or rent, or if you have depreciation and amortization. Those are non-direct business expenses. Those are other business expenses. You'll also see that in other income. We had regular income and other income. Your regular income is your business income, your income from performing business, performing jobs, whereas other income is maybe interest that you earned, or if you have an investment and you earn money off of that investment, or you have referrals and people pay you for those referrals, then that would all be other income. Expenses will vary depending on the company. Some people travel a lot, so we need to break down travel. Some people have utilities and some don't. Some people have a cell phone, some don't. So we really need to figure out what works for you. This needs to be customized specifically to you and not something generic, because this is your business's chart of accounts. Never use anything that is generic, because it doesn't tell you how your business is performing. We're going to provide this sheet for you guys to look at and work with in case you have any issues. But as always, if you have questions, need help, get stuck, whatever, please feel free to give us a call, shoot us an email, go to our contact us page, anything like that, and we will be happy to help you. Have a wonderful rest of your day.